VA Home Loans 101 for real estate agents, um, through obviously as a um, uh, on behalf of the North San Diego County Association of Realtors. Thank you guys for taking the time. Probably just going to run through run through everything pretty quick. I'll get kind of some baseline understanding of what is important to you guys, and we'll kind of freewheel it. And then at the end, I'll leave some time for Q&A so that anybody that has to get to work can kind of jump out, and anybody that wants to stick around and get some more in-depth questions can do that. But yeah, most communication, if you can, through the chat would be super useful when we start like opening it up and having people talk. I don't even know if we have the capacity on this one, but it just gets messy anyway. So this seems to work out good. 10:04. So maybe one more minute to be respectful of you guys' time, and then we'll get rolling. And yeah, and if you can't hear me or if something's going off, just let me know. Well, okay. So what I can do too is while I'm waiting for anybody else to kind of, to come in, are there anything in the chat? Is there anything specifically that you have questions for? Are you kind of generally trying to learn overarching, how VA works, or are there specific questions, specific topics, or anything that I should spend a little bit more time on? Maybe give me a heads up in the chat if there's anything like that that I can go through. We'll go through quite a bit, but if you can kind of give me an idea in the chat if there's any specific questions or anything. Oh, and I don't know. I'm probably a panelist. So if your drop down box in that who you're messaging doesn't have panelists in it, if it's just a hosts, I probably can't see you. So I'm not exactly sure how it's set up, but um, I'm a panelist, so hopefully your drop down says panelist.
It does.
Okay, perfect. Anybody have any specific questions or anything, or should we just get started? I'm kind of not sure because I'm not getting a ton of chats over here. So if you get started or good to go, or shoot me some kind of message, just and I'll get rolling if there's no specific questions. Sweet. Okay. Thanks, Sheila. Appreciate it. So, all right. So, really, what we'll roll through let's see, questions about multifamily and two veterans getting in on multifamily. Marissa, very, very good question, and something we're definitely going to go over, something kind of near and dear to my heart, the concept of VA house hacking, or, so, okay, so we'll get there for sure. So thanks for making that question. Okay, so we're gonna get started. So and as you have questions or if something comes up, just put it in the chat, and I'll probably get to it as I get to each starting point. So or each stopping point, so that at each point in time, I can just kind of we're not kind of stopping and starting. I'll just stop at specific points. Okay, so first and foremost, just to kind of give an understanding of the military landscape in San Diego, there are seven major military bases in San Diego over mainly three branches of service. The other branches of service are there, but they're just kind of they're a lesser kind of contingent. So you got the Navy big contingent here, Marine Corps, and the United States Coast Guard downtown. So there's 136,000 active duty military members. This number is obviously changing all the time, but the population is 400,000 if you include family members. So 12% of population, or 1 in 8 people in San Diego, are some kind of like adjacent or military specifically, or military family member, which is a lot of the population. So they're all over the place. And there are some opportunities when it comes to real estate related to military. They're always on the move and in need of resources. They're moving in, they're moving out. Most orders are around 3 years. So, if you get a bead on, or if you have like some kind of a referral program within your company, and you're able to, get people coming out from Virginia or out from Florida or out from the schools or whatnot. I mean, you can get a lot of people coming in, and you can kind of start getting a bead for when PCS, permanent change of duty station season is, and when they're moving in. And and catch them at the time when they're trying to make a decision between, okay, are we going to base housing? Are we going to rent something, or are we going to buy something? Military families depend on each other for advice and referrals. So if you show a level of expertise in the area of VA, it creates an opportunity for referrals to other military families because it's a very tight knit community. In an economic downturn, military income is far less affected. It's government income. So when the unemployment becomes problematic, military buyers are still very strong. And military members receive benefits that, including the VA loan itself, which is one of the best loans ever. Military members receive tax-free housing stipends. BAH, basic allowance for housing, is a tax-free income that can be used to purchase tax advantage assets like a house. So it's an amazing benefit for military buyers. One of the slides that I use a lot, I do a lot of education for Consumer Direct on base and for some of the base housing entities, military, Lincoln, and well, now it's Liberty Military Housing. One of the slides that I show them is here's the cost. I mean, you should be cognizant of the cost of buying. This is the cost of not buying. This is BAH, the basic allowance for housing, which is tax-free income, and it's based on rank. And these particular figures are with dependents. You either have with dependents or without dependents. So Eve 1 through 4, 3627 per month. Yearly, that's 43 grand. That a 3-year total. If somebody comes to Camp Pendleton or San Diego or whatnot, this is based on Pendleton zip code, so it's North County, obviously, the North County Association. But the 130 grand over 3 years, just down the drain if you stay on the base or you pay rent or you pay it to your landlord. So that goes all the way up. You can see on some of the lower officer ranks, O4 an O4 officer rank is $183,000 over 3 years, and that's tax-free income. So that's a slide that I kind of go over, and that kind of underlines some of the benefits of active duty, housing stipends. So I'm sure you guys, if you pay attention to keeping current matters or whatever, this Federal Reserve study comes out every I think 3 years or something like that. That's why it's 2022. But the difference between a homeowner's net worth nationwide and a renter's net worth is massive nationwide. So I show this to a lot of the military buyers also. And part of the reason is because of this chart. If you're taking that cash and putting it towards something that's appreciating or at least holding its value in an inflationary environment, you're good to go. So the veteran landscape, so active duty, veteran landscape, 250,000 veterans call San Diego home, 40% of which live in North County. So San Diego is the third largest county in the U.S., behind Los Angeles, and I think, what's the one in Arizona? It's escaping me. I'm getting old. Maricopa. But it's the largest county for post 9/11, Iraq, Afghanistan era veterans. San Diego's the largest. About 15,000 veterans or military members get out of the military in San Diego, and about half of them try to stay, and a lot of them are, doing education while they're in. They're highly sought after, and they get good jobs in the area. And San Diego is a very military friendly area. So real quick, I won't drone on this. I was in the Marine Corps from 99 to 2004, kind of fell out of the Marine Corps. I did the Iraq, Afghanistan era Marine Corps. Got in out of high school, got out in 2004, did some school in the Marine Corps, but not a ton. And so got out and got directly into lending. So most of my business is very, very education and planning focused. I hire veterans, I train veterans, I do a bunch of nonprofit stuff. And then if anybody is in a real estate office where you're looking for agents and you want to kind of go and help agents or build agents that might be military or that might be spouses, Department of Defense has a thing called Skill Bridge that you should look into, because that's basically what happens is the military member's salary still gets paid the last 6 months, 3 months, or whatever the term is, and they basically get paid to go to your office and learn how to be a real estate agent. And they still get paid. So one of the obviously difficult things for military coming out of the service is your income gets cut off. But if you had a 3 to 6 month bridge where you can kind of grow, if you have any questions about the DoD Skill Bridge program, if you're a team or if you're an office or if you're looking to grow or if your office is looking to grow, let me know and I can give you more details on how that works. And then I wrote the VA Home Loan Field Manual, and then I do a bunch of courses. So that's either nonprofit, consumer direct, or agent courses off on base, that kind of thing. All right, so let's get into kind of the meat of this and of the VA loan itself. So I'm going to assume that everybody kind of has a baseline understanding of lending. I used to go through DTI and loan to value and that kind of stuff, but it was probably overkill. And again, if anybody has questions while we're going, just pop it in the chat, and I'll stop and cover it between segments. Okay, so the VA loan itself is not provided directly by the VA. The VA doesn't do the lending, which is super helpful whether you know it or not, because if the VA did anything, it would take forever. You wouldn't be able to get these 14-day closes or, very, very quick closes and communication and stuff. It would be much tougher. Traditional banks and lenders supply the loans, a number of them. Obviously, USAA, Navy Fed, Chase, Wells, or in our case, correspondent or broker side or whatever the situation is. But it's ultimately traditional banks. What the VA does is they guarantee them on behalf of eligible veterans. So they provide a guarantee on behalf of eligible veterans. So we'll go through eligible veterans and eligibility. And prior to 2020, the cap was the county loan limit where the property is located. In San Diego County right now, the true VA loan limit cap, if you look at it, is $1,104,000. But as you'll find out, that's not as relevant anymore. So let's look at eligibility first. So a military member becomes eligible for VA entitlement via a few different things. 90 days active duty during wartime. So, and I think wartime, generally speaking, we've been in since 9/11. Basically, it's just been a kind of, it's been considered wartime since then. 181 days active duty during peacetime. So you may run into that with some like Gulf War era or before that. 181 days active duty during peacetime. 6 years reserve service. So you got to be really careful with reservists because sometimes they'll think they're eligible, but they need a full 6 years. Or let's say they were activated to active duty for 90 days, not under a training circumstance. It can't be for training. It has to be like actually activated for, some kind of, activity for 90 days. Or in certain circumstances, a service member's spouse will get it if the service member dies in service or as a result of a service-connected disability or is considered missing in action, prisoner of war. So there are circumstances where the service member's spouse can have it passed to them. There are a couple different kind of caveats. They can't be remarried. There's things like that. And we don't run into it a ton, thankfully. But that is a possibility. So those are the main core kind of elements. The way that you kind of tell not kind of, but the way that you tell if a veteran is eligible for a VA loan or not is you take their social security number, you take their year of birth, and most lenders, basically what we do is we plug it into the VA portal and it'll pull up what's called a certificate of eligibility. So one thing that we'll do primarily is pull up a certificate of eligibility. It'll identify the veteran themselves via social security and the name. It'll say what branch they were, their entitlement code, in other words, how their entitlement works or why they're entitled to the VA loan. It'll show whether or not they're going to need to pay a funding fee, which I'm going to run through in a little bit. It'll show any prior loans charged, loans that are active now, which will kind of come into play in a little bit. And then it'll say, okay, is it a subsequent use funding fee, or is it, or is it a first time use funding fee, which again, that'll come through in a second when we go through it. And then also what happens is if they have service-connected disability, in other words, if a veteran has any kind of a disability rating, that income will be listed here. So the veteran doesn't have to provide us with, any kind of documentation. We pull it and this will say veterans exempt from the funding fee due to service-connected disability compensation of X monthly, $1,000 monthly, $1,200 monthly, $5,000 monthly, depending on their disability rating. And we can use that as tax-free income in the file. So, okay, so who can use the VA loan? So when I say veteran, it's kind of across the board. Active duty members and veterans under the circumstances we discussed, 90 days active duty, that kind of thing. A veteran and their spouse, or a military member and their spouse. In other words, their spouse, if they're married, can go on the loan. You have to be careful of California being a community property state. So VA and FHA, you have to adjust for for household debt, meaning even if the spouse is not going on the loan because it doesn't make sense to put them on the loan, we still have to pull a credit report and apply the debt or lack thereof to the file. A veteran and another eligible veteran. So, Marissa, to your questions about two veterans getting in on multifamily, there are a little bit of a caveat to that, but no, two veterans, two military members, they can do dual eligibility or dual eligibility. And there are some things that you're gonna want to plan for because they may or may not want to utilize both of their VA eligibilities for one property because it ties it up really for no reason. So you might be able to use one veteran's eligibility and leave the other one freed up. And then you've got a veteran and a non-veteran. So that doesn't happen much, and that's why there's a star there. That's more reserved for very, very, very close, almost spouse-like relationships that aren't. I shouldn't even have veteran and non-veteran on there because it's very, very difficult to do. It's like a long-term, very documented relationship, like a what would that be called? Like a I'm not sure, but like when they're not married per se, but they're basically married, and you can make that case. What happens is the loan has to go to VA for approval, and you have to put a down payment. So usually 12.5% down because that's half of the 25% guarantee that VA provides. So sorry, I'm rolling through that a little bit quick, but that's that. That does happen. And then widowed spouse, like I said, sometimes the eligibility can transfer under certain circumstances. So real quick, prior to 2020, VA limited 100% financing, in other words, zero down to the conforming loan limits. So, but after January 1st, 2020, there was HR 299 that was passed that had, the Blue Water Navy Vietnam Veterans Act, which doesn't have anything to do with Blue Water, the Navy, or Vietnam veterans. I mean, kind of does Vietnam veterans. But in essence, what happens now is, let's say I don't have a VA loan that's already tied up. Let's say it's clear I've never used it, or I've sold a house and I've got clear eligibility. You can go up to whatever you want. I mean, we've got a property in escrow now at 1.85 million with zero down, at a 5.5% interest rate. So that's, you still have to qualify for it, right? You still have to have the income and all that kind of stuff. But VA got very, very, very flexible for an area like San Diego because you used to have to put a down payment on top of that. On top of that loan limit, if you exceeded it, it wasn't the entire difference, but there was a portion of a down payment that you had to make. Now, when you have 100% of your eligibility freed up, you don't really have a limit. It's just you're only limited by what you can qualify for from an income standpoint. So there is no limit. The limit does come into play if you let's say you've got a property in Virginia on a VA loan now and you want to buy another one. We'll get into that. Okay, so even if I'm eligible for VA, is that the best option? In my kind of office, generally speaking, this is very generally speaking, VA is better than conventional. Conventional is better than FHA. FHA is better than renting. That's kind of what I take clients through. So, I mean, in essence, if you can go VA, you generally want to go VA. If you can't go VA, it's between conventional and FHA. And FHA is really somewhat of a stepping stone to conventional because it has its mortgage insurance. So that's kind of, obviously that's not 100% of the time, but that generally holds true. So I'm going to show you kind of some of the differences between, or some of the advantages between VA conventional, because FHA and all that would be overkill. But from an interest rate standpoint, I can tell you today, average interest rates on a conventional loan are somewhere in the low sixes, 6 and an eighth, something like that. And I'm talking about with no points. VA today is 5.5, 5.625, so VA is much better in interest rate under the same terms than conventional. Again, there are ancillary kind of things like the funding fee and stuff like that we look at, but from an interest rate standpoint solely, interest rates are much lower. From a credit standpoint, when you do a conventional loan, there are things called loan level price adjustments. And if you are over 780 FICO, you're good. But 780 to 760, 760 to 740, 740 to 720, at every 20-point increment, you start getting hammered both on interest rate, but also potentially on mortgage insurance if you're not putting 20% down on a conventional loan. VA is really not impacted by credit at all. There's maybe some little incentives if you get over a certain amount, like if you're over 700, but you're not going to get hammered at all on credit because VA's goal is not to do that. VA's goal is to provide, loans to or guarantees on loans to veterans. So credit is, a lot of times I'll get clients come in and say, hey, I think I probably need to do some credit repair. I'm like, oh, you're going VA and you're 720. You don't have to get to 780. You're already as good as you can get, and VA doesn't hammer you. So that's a big benefit. So from an income standpoint, VA is not really a debt to income based loan. It's what's called a residual income loan. But when we do our pre-approvals and stuff, I mean, the we generally speaking use DU or use automated underwriting, and we kind of pay attention to where they will approve it. And so this is kind of more of a guideline, but in essence, first to define debt to income ratio, your house payment plus your monthly debt has to be under X% of your income, gross income. So with conventional, basically your house payment plus your monthly debt has to be under 50% of your gross income to get an approval. VA, I mean, I've got one right now at 78, and it sounds ridiculous, but they have a lot of residual income. They have a lot of income after everything's done. So VA has much more flexibility. That doesn't mean that you have to go that high. That just means that VA gives you a lot more flexibility in terms of what a client can qualify for. The way that VA works and the main benefit of VA loans versus conventional, you guys may know this, but it's basically there's no mortgage insurance and no down payment required. Conventional, you can do as little as 3% down with conventional. You don't have to do 20% down with conventional, but the lender requires 20% safety in all cases, whether it be VA or conventional. So if you look at this loan to value kind of breakdown, if you look at $1 million property, the bank's exposure that they want is a maximum of 800,000 or 80%. They want 20% buffer in case the client doesn't pay. So what does VA do? This is the gist of VA. Based on the client's eligibility and based on the VA program and their entitlement, the VA basically just does a 25% guarantee. So that guarantee covers the bank, and they basically say, in this case, okay, the purchase price is $1 million. We're going to cover you all the way down to 750,000. So we've got a $250,000, guarantee where if this veteran doesn't pay, we're going to make you whole. Therefore, the bank is able to not require down payment and not require mortgage insurance. The key is this VA guarantee, and that's kind of the gist of how VA works and what the difference is between VA and conventional, where that guarantee doesn't exist and you may need mortgage insurance or 20% down to cover that gap. So less restrictive credit, lower interest rates, no down payment required, with full eligibility, no monthly mortgage insurance expense, and more flexible debt to income ratio limits. So in most cases, if an individual qualifies and is eligible for VA, it's the best loan available. Okay. True or false? In the chat, VA loans are for first-time buyers only. What do you guys think? Sheila says no. Marissa says false. Okay, cool. So false. The only restriction is the VA loan must be used to purchase a primary residence. Now, so it has to be a primary residence. It has to make sense that it's a primary residence at the time of purchase. They can rent it out later if they end up leaving. And I say purchase a primary residence because you can do a VA loan, a refinance if you want to drop the interest rate on a rental, but the purchase must be used as a primary. So it has to be a primary, no investment, no second home. My client can have two VA loans at once, yay or nay? Anybody? Okay. So if VA entitlement remains, you can use it if so my client your client can have two VA loans at once. That's true. So VA loans are like a rechargeable battery basically. So if you have your full charge and you use a portion of it and you have some remaining, you can use that remaining eligibility. So there's a way to calculate it. I won't get into kind of the details of it, but it's based on your new county where you're buying, what the max eligibility is based on that county, and what's already charged on that VA certificate of eligibility that I walked you through, and and the remaining amount you can use and calculate what your new amount is with zero down. So you can have two at a time. You could potentially have three at a time, as long as you have remaining eligibility and as the new property is a primary residence. How does that work? I've got a property in Virginia. It's on a VA loan. I get transferred to San Diego. I rent my old one out and I buy the new one as my primary residence. It just has to be a primary residence at that time. My client can buy a $1.5 million property in San Diego with zero down payment using the VA home loan. We kind of already went through this. As of January 2020, because of that Vietnam Veterans Blue Water Act or whatever, and as of January 1st, 2020, with full eligibility, the loan limit is not capped by the VA. When you have more than one VA loan, that's when the VA loan limits for the counties come in at this point. My client can buy a fourplex using the VA. So, Marissa, that's kind of to your question. I can just kind of answer it and then I can elaborate a little bit more. 1 to 4 units is considered residential. 5+ units is considered commercial. So, if you're 1 to 4 units, and as long as you could show that one of the units is occupied, that's what we call like house hacking, VA house hacking. That's basically, and so I'll give a perfect example for Marissa. Marissa's question is, I have specific questions about multifamily and about two veterans getting in on multifamily. Perfect example of this. I have two clients that are active duty. They're not married. And they went in on a property in Oceanside, and I think the purchase price was 1.6, and it was a fourplex. And so, in essence, what we did was we structured it where they're going to live in one unit. They purchased it together. They live in the one unit. They use the long-term rental income from the other 3 units along with their incomes that they have. And in essence, that's how they purchase that property. You can't use Airbnb income or prospective short-term income to kind of show more income. You have to use long-term income. And we can use 75% of the gross rents. So let's say your client moves into one and whatever and their rents on the other ones are $4,000 total. You can use 3,000 of that because we're going to hack it 25% for vacancy and for expenses and that kind of thing. So, but that helps a lot. So that is a very, very advantageous situation and something we're seeing a lot more. And it's getting more prevalent with ADUs because now ADU guidelines are getting a little bit lightened, and they're starting to look at ADUs and look at ADU income and that kind of thing. So that's, I think, getting better because it used to be you have to have 4 separately metered units, and now you've got a situation where they're lightening up on kind of what you can do with ADUs and using that rental income. Single family renting rooms, you can't use that income. But okay. All right. So hopefully that answers your question. If it doesn't, or if you have more specific questions. Oh yeah. So the question that Marissa has is, the other units have to have active tenants. They do not, but well, number one, if your debt to income is such that you don't need the income to qualify. Let's say I've got a client who's got BAH, BAS, base pay, and their income is sufficient to qualify for the house without using rental income. Even if it has rental income, I don't use it because it's unnecessary complexity. So it makes the file more complex. But if they need the income to qualify, what you can do is they don't have to have active rental units. You can find a tenant, have them sign a lease, and then use that rental income to qualify. And there's some more context to that where if you reach out to me, I can kind of tell you about it, but it's probably a little bit too in the weeds for this. So just let me know and I can kind of walk you through a little bit more about that. Okay. So even though my client's spouse is not a veteran, they can still go on the VA loan. We talked about that a little bit. A spouse's income can be used if it is stable and from an acceptable source, just like any other loan. So if it's the spouse and they're working, we can use that income as well. So there are circumstances where a VA loan may not be the best option. I kind of alluded to this. That's true. So when planning any job, you want to first figure out the goal and then apply the right tools. I always tell clients, you wouldn't pull out, a saw and then learn that your job is like to change the doorknob. So it's really important to understand what the goal is on the front end, and then the VA loan might be one of the tools. It's most often one of the best tools we can use in combination with the client's scenario. So a couple examples of where the VA is like not always the best. Let's say a client is in town and they're buying like a small condo or something like that, and it's a temporary deal, and they don't want to tie up their VA because they're planning on buying a much more expensive home later on, and they want to reserve their VA. That would be one potential reason, where they don't want to tie up their VA. Or let's say your client's planning on putting 20% down anyways, and they don't have service connected disabilities, so they would have a funding fee. If they would have a funding fee and they're putting 20% down anyways, that may swing it to conventional because they don't have the mortgage insurance issue and they may not want to pay a funding fee. So they may elect to pay a little bit of a higher rate, which comes with a conventional loan, because the funding fee is, which I'll show you on the chart, can be, 2 1/8, it can be a pretty good, not 2 1/8. In this case, with the down payment, it would be probably 1.25%. So if they don't want to pay that funding fee, it may make sense. So in all cases, education and planning is key. So I'm just going to run through some like miscellaneous VA stuff. I kind of have been already, but I'm gonna run through some miscellaneous VA stuff, and I'll probably like wrap up in the next 10 minutes, and then I'll keep like a good 15 minutes for anybody that wants to stick it out and ask any specific questions. So first of all, the VA funding fee. VA funding fee is how the VA funds its program. So in essence, for purchasing construction loans, it really depends on down payment. So if you're putting less than 5% down, usually 2% down, you could see that if it's your first time use, like you haven't used your VA ever before, it's 2.15%. If it's your subsequent use, that jumps up pretty hefty. Let's say if you're buying $1 million property, doing $1 million loan, putting zero down, and it's your subsequent use, that's $33,000 rolled into the loan. So this is the only closing cost that can really just be rolled in. You don't have to come in with cash. But this is a lot. I do a lot of planning around this because if you put 5% down, it drops to 1.5. If you put 10% down, it drops to 1.25. In the case of subsequent use, a lot of times I'm trying to figure out how clients can get 5% down, because if they get to 5% down, not only is that 5% equity, it's going into their other pocket, right? It's not a fee, but it's reducing their fees pretty substantially. So if they can get there, that's kind of the planning that we want to do. If they have service connected disability, 10% or more, if they're getting a check for service connected disability, it's waived, it's zero. So it's so massively important. The other thing that's really key about this is, let's say they don't have service connected disability, but they think they warrant it. If they go to the VA and they file an intent to provide to file for a disability or whatnot, it'll timestamp that date that was filed. Once that timestamp is dated, let's say they buy a house and they pay 2.15% in funding fee, and then after they pay that, they get the VA disability awarded. They will back pay that back based on the application date in the beginning. So a lot of times, if I'll ask clients if they think they warrant disability, and they're like, yeah, I think so, but I just haven't had the time to do it. I'm like, well, do it now. Jump online, takes no time at all to file that initial date, stamp that. Then when you buy, you at least have an option of potentially getting that back. And that could be tens of thousands of dollars. So anyway, so that's the VA funding fee. There are also things that throw a lot of people off. When I work with VA clients specifically and offers go out, I always, always, always have to call the listing agent, because a lot of listing agents have this as a misconception. They think their seller needs to pay because VA has non-allowables. VA does have non-allowables. What VA says is certain fees, certain administrative and escrow fees and title fees cannot exceed 1%. They can't exceed 1%, and I'm sorry, but I think that's of the value. So, gosh, it might be the loan amount. That's a silly thing to not know. We kind of never run into it, honestly, because the first issue that you'd run into is, let's say you go to Navy Fed and they charge a 1% origination fee. If the lender charges a 1% origination fee, they use all your bandwidth for any other fees, and the seller has to pay the rest. It's a silly thing to do to charge an origination fee as a VA lender, because if you charge a 1% origination fee, all of a sudden you have no room for anything else because we've used up all that bandwidth. But let's say the lender does not charge a 1% origination fee. That escrow, title, notary, all that stuff lines up and it stays under if it stays under 1%, which in San Diego it always does, there's, you really only run into issues with really, really low purchase prices. And I think that's the answer to that. But we just don't really run into non-allowables at all. So there's not really any non-allowables unless you have a lender that's kind of in a silly way charging an origination fee. And usually, if you just get rid of that origination fee, that solves your issue. But if they're charging origination fee on VA, you might want to look elsewhere. So that's non-allowables, and let me know if you have any questions about that because I know that's a little bit funky. Um, termite, unlike FHA and conventional, termite is required. Section 1 is required in these states below. See, it says required, not required, or depends on county. Generally, the states in the north, it's just so cold, they just don't have termites really, or to whatever level would be required. Some of those upper kind of light, blue states, the light blue states, that just kind of depends on what county you're in, and that might be probably some of the further south. You got to do it, and if not, you don't. But most of and including California, Section 1 is required. So Section 1 clearance is required. Section 2 is really underwriter discretion. It's like Section 1 is active infestation. Section 2 is things that could potentially lead to active infestation, but you generally don't have Section 2 issues. You generally do Section 1 clearance. And that's required on all VA. On FHA and conventional, even if you do a termite report later on, you don't want it, you can just write it out of the contract and the underwriter shouldn't request it. But VA, you're always going to need Section 1. I talked about this a little bit. VA wants to ensure that after living expenses, the buyer will have a reasonable amount of money to live on. So, in addition to DTI, which is a thing, residual income, the residual income is really what the VA is looking at, and it looks at taking out taxes, maintenance, debt, and all that stuff. This is a little bit lenderish and in the weeds, so you guys don't have to really understand this too well. If you get a pre-approval, it should take into account debt to income, but more so residual and reflect that. Condo projects are funky. So just like FHA and condo projects right now with conventional are very funky. If you guys have had any of those lately with the balcony stuff or any of that stuff. But the good news is with VA, if you have an approval, you generally don't have to deal with any of that budget and maintenance and condo, all that stuff. So VAs are really good for that reason too. Condo projects, they have to be VA approved. With FHA, if they're detached condos, you don't need approval for FHA. But with VA, whether they're attached or detached, they need to be VA approved. So you want to double check whether or not they're VA approved. I got a couple minutes so I can kind of walk you through like some best case kind of deals. VA condo approvals, they don't expire like FHA expires, so that's good. When searching for a condo, don't be specific. So I'll show you real quick if I can get this up real quick. I'll pull up the VA condo report. And really what you don't want to do, and a lot of times your lender's doing this, but you don't really want to plug in the name because if you misspell anything at all, or if it's in a in the name of a tract or something, I'll usually just plug in like Oceanside, California, and that's it. And I'll pull up all of them in Oceanside, and then I'll kind of scan through and see if I can't find them. But you got to be careful because sometimes they're listed under parcels. See how it says parcel map 1620? And unfortunately, it doesn't list it by the address. It lists it by the name of the project. So sometimes it's a little bit funky to make that work. But because they don't expire, if you look in the MLS and you find a history of the sale, like if there are sales in there that are VA, generally they're VA approved and you'll find it on the list somewhere. So let me know if you run into any kind of issues with that. So last thing, I don't know, one of the last things I'll go over, I don't know if there's much more than this, but VA appraisals are a little bit different than conventional. The VA appraisal is, it used to be seen as much worse because you couldn't control who the appraiser was. Now with conventional, you got to go through a third-party management company anyways, and that's been for years and years. So VA is the same way. You order it through the VA portal, and there are VA-approved appraisers who are just, general appraisers who get approved through the VA, and they go out and do the appraisals. The difference is if there's going to be an issue with value, they'll do what's called a tidewater initiative. So, okay, conventional loan, you order an appraisal, your purchase price is 850, the value comes back at 840. You get a copy of the appraisal and you can kind of look through it and see what the appraiser did and see what was wrong and that kind of thing. Or see if there was anything, or you renegotiate whatever the situation is. VA is a little bit different in the sense that the appraiser will go out, they'll do their inspection, they'll do their due diligence, they'll find their comps, and then they'll say, hey, if they think it's going to come in low, potentially, they'll reach back out to us and they'll say, hey, Daniel, this looks like it's going to come in low. We're invoking tidewater. I'm like, okay, shoot. I reach out to the listing agent and the buyer's agent and I say, hey guys, the appraiser has said that basically tidewater was called out. That means that if we don't give any additional comps or data, it's probably going to come in low. They're not seeing the value. So can you provide me any comps that you think help? And the buyer's agent will send their comps, the seller's agent will send their comps or any data on improvements or anything, and I'll send that back to the appraiser. And then sometimes the value just comes in fine and they may have missed something. Sometimes the value then comes in low and you can kind of see how low and figure it out from there. But that's Tidewater, and that's how VA is slightly different than conventional when it comes to appraisals. All right. That's really, for the most part, all I've got. If you want these slides or if you want a copy for your office or for clients or anything else of the VA Home Loan Field Manual, there's a bunch of those running around all over the place. But if you need anything, you could just, I have just email me is probably easiest. I had a link to the website, but something was up with that. So, or Amazon or whatever, but it was just too complex. So you could just email me and I can get you a copy. But that's really, it's 10:45 now, so we're right on schedule. So I've got about 15 minutes to answer any questions you guys have, or if you guys are all set, um, let me know. All right, so Marissa, I have another specific question about a veteran wanting to use a VA loan to buy a property, but put the property in a trust. How does that work? Can the trust be existing? Yeah, so that's not VA specific. That's any purchase at all. You can always close in a trust, and you can do one of two things. If you have a trust and you want to put the loan into a trust, and I'm talking about, a living trust that you control. Number one, you can close in the trust, but you basically have to get a copy of the trust cert and you have to provide it to title and all that stuff. And that's all fine. And then you just sign as a trustee and you get writer's, cramps because you have to sign, Daniel Lehman, trustee of the Lehman Family Trust, dated, da, 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 da. The other option that's really, really easy is, and a lot of times what we lean people towards, especially if it comes up late in the game, is close as an individual. Daniel Lehman sold in separate property, or Daniel and Mariela Lehman, husband and wife as joint tenants, close. And then the next day, go do a quit claim and sign one document that says we're moving sole ownership into the trust ownership. But yeah, super, super easy to do. That has to do much more with title than with trust. Or wait, sorry, title than with the loan itself. And Marissa, you'll have no problem at all. And hopefully that answers your question. Of course. Yeah, thank you. Any other questions? Thanks, Sheila. Appreciate it. If yeah, if you guys are good, you can jump off. If you have questions, you can reach out and I can answer them here. Or if you want those slides of the book or whatever, just email me. Or if you have questions that come up later, any VA questions specifically, and while you guys are kind of doing that also, I mean, yeah, just want to thank the association too. Thank North San Diego County Association of Realtors for providing this education. You can jump on their site and take a look at their education calendar. They've got a ton of stuff all the time. And obviously caravans and events and all the other great stuff that they do. So I appreciate them allowing me to bring this information to you.